There have been some interesting moves in the markets recently, and in fact, the Dow Jones Industrial Average, as of the time of reporting, is very close to having its best month since 1976. But we must be mindful of the fact that they're well off the highs that we saw at the beginning of this year and the back end of last year when we saw record highs for the Dow, the S&P and the Nasdaq. European markets hitting those highs in January this year. But whichever way you cut it, we are well down from those levels. But we are enjoying a little bit of an uplift. Is it here to stay, or is it just a bear market rally? Well, now let's get an update on this with Ron William from RW Advisory. Ron, welcome. We do pick these moments to talk about markets and what a rally we're in at the moment. And of course, that question really has to be the opener for you is this a bear market rally, or are you comfortable with going long for a long period of time?
Bear market rally for now, and certainly in line with the traditional 20% or so upside scope as part of a big bear market rally in a big bear. And that's according to our cycle framework, and partly also supported by a positive seasonality effect known as the Halloween effect, literally on the day, where we tend to have a relief rally after a fall crash pattern that tends to coincide with the autumn months of September and October, October being the key in terms of the anniversary month.
Okay, let's take a look in some detail with some numbers. I want to bring up a chart first of all of the S&P 500 because I think this illustrates what you said absolutely perfectly. We were down 27.5% from the record highs we saw at the beginning of the year down to the recent low, and then we've got this rally underway. Now the big question is, of course, is how fast, how far we should be taking this up, and what sort of metrics should we be using from a technical analysis point of view to give us some insight?
Well, we can look at the historical guide in terms of what to expect in the near term, and certainly the summer of this year, so just a short while ago, we did see a reversion back to the long-term mean, which was that 200-day moving average. Now, just as a quick side point, the Dow is already at that long-term 200-day. S&P 500 still has some juice to go. This is a minimum price objective with further upside beyond the 200-day on the chart. I just see it there around the 32.95 mark on your chart. Further up into 4,400 if it does complete the traditional bear market rally.
Going back to the S&P 500 just very quickly and just follow through with that, we are still some distance away from the 200-day moving average. So more upside to go for the S&P than the Dow?
Yes, I mean, it's interesting. We're getting confirmation signals across the board. So the Dow, in terms of blue chip, is leading, certainly being high beta and high volatile. Just as it fell on the way on the downside, we're now seeing the bounce back on the upside. S&P 500 being broader, and even the Russell 2000, which includes some of those zombie companies, hasn't made a new swing low and actually is holding that support. So across the board, we're getting a general broad-based rise on the stock market indices and the stocks leading them.
Okay, well, let's take a look at your first full screen graphic that you provided, because you talk about this full crash pattern. We've spoken about this before. Let's bring up the illustration and you can talk us through it, because this full crash pattern seems to be developing quite nicely.
The full crash pattern is part of our roadmap model for what happens late cycle into a transition period, which is a process, not an overnight move, and part of a three-step process, I should say. So a fall, rally, and then rest of fall. But what's interesting is if we actually look at the seasonality overlay, i.e. the monthly breakdown of market performance on the equity space, what we can see is the midsummer rally, July into August, which is what we did see after a very negative June month. Then we had the fall crash pattern actually in September, which is typically and statistically what happens. And with the worst of that move already done, what that tends to lead to a false low in the same month, September, and a true low the month that we're just closing in October. That's why we celebrate the anniversary month of October for significant volatility. But if we look at the top, if we look at the charts on the right insert, This actually gives you a breakdown of the week-on-week performance. And mid-October is where we usually get that true low before a positive respite, i.e. a relief rally from oversold conditions in the final days of October, and hence the Halloween effect, which leads to this positive seasonality. Now, the interesting point here is that tactically, bear markets tend to lose momentum during the month of October. And so people will know the old phrase, sell in May and go away. The problem is they don't come back to buy thereafter from November onwards. And so this is ultimately what this chart mosaic is showing you. The September-October drawdown, that leading to an oversold condition and a relief rally that follows. And then also October often marking that temporary oversold condition, which leads to a relief rally.
So now the question is, how long does this continue, and what happens as we go into 2023? Should we be holding on to this bear market rally into next year?
I think for those that can be positioned tactically in an opportunistic scope, but also with good risk management due diligence, the answer is yes. Those who are maybe more strategic, maybe it's an opportunity to look for further hedges to the downside into the new year, if that is the better mandate. But for now, I think a lot of people are already on this potential bounce back trade, which is already, as you say, some of the strongest bounce back we've seen since the 1970s, if you look at the Dow. And most importantly, if you look out into the future, as the market often does, the best 6 months are ahead of us based on back-tested performance of this so-called Halloween effect, i.e. post-oversold conditions in September and October, when people sell, go away, and then come back to buy. That's the line outperforming on the top side there based on peer-reviewed academic research. And particularly this year, I think more than any other year, because we've had elevated market volatility, black swan event risks, which have already proved scary to most investors as we approach this ominous Halloween festivity. So I think there's a behavioral paying respect of those portfolio losses and just looking for a kind of more future news to price in. Potentially, I think a good question we could be asking here is what could change for the better tactically in the months ahead. And so we could maybe think about a Fed pivot, or perhaps even a China reopening pivot, or any other unknown scenario that could potentially provide some support in the market over the next few months.
That's an interesting point, actually, isn't it? Fundamentally, we have a situation where some people I know are now hopefully perhaps maybe looking towards the Fed for some sort of guidance. We've got the Fed this week. As we talk, we're awaiting the Federal Reserve interest rate decision this week. And some are hoping that the Fed may begin to indicate that they feel that inflation is now, or the worst of it at least, is behind them. And we will no longer see the sort of aggressive attitude towards interest rates. That certainly seems to be one big issue. The other issue, I know that, I can't believe I'm talking about this again, is midterm elections in the US. I cannot believe we're at that point again. Explain how this reveals itself, if you like, to us traders, and what we should be doing to put ourselves into a position where we can benefit from the midterm elections in the States.
The US presidential election is an important 4-year cycle that has stood the test of time for a while. And the midterm itself is the best part of the cycle pattern. You can see there between November 2022 and July 2023 is a strong boost predicted based upon the research of Ned Davis research. And this is not just a random mix of numbers. I mean, ultimately, this is showing a likely bottoming out of, as you can see there, monetary and fiscal policy that will create the contrarian boost effect into the midterm as the existing leadership looks to get voted back in, or potentially some of that positive surprise that I've alluded to that could just be supportive to the market and then show itself through these numbers. So currently, it's the best part of the 4-year cycle as we go into the midterm elections. Tends to be a sign of the existing leadership changing course in order to boost votes. Or it could be an additional positive factors that I just mentioned there, the Fed pivot, or maybe a China reopening after the Party Congress and the Chinese New Year ahead.
So let me just quickly ask a question, if I can, I want to return to that full screen graphic, because on the left-hand side, that November 22 to July 2023, what are you saying? Is this is the expected move as per that source for next year? Because if you look at that green box, it continues to rally thereafter. Is the suggestion that the rally is going to continue from that point? Because are we not talking here about a bear market rally that's going to run its course sometime in the first quarter or second quarter of next year?
Yes, that is an important distinction to make. So according to this research, this is the best performing part of the cycle. But where my analysis maybe differentiates somewhat is that this is likely a positive seasonality based on the so-called October Halloween effect and the relief rally post oversold conditions in combination with the midterm presidential election. But ultimately, it is a short-term tactical upswing into a structural bear. And as you correctly mentioned there, Jeremy, from Q2 onwards, that's where my bigger picture cycle work continues, an extended rollover into the second half of 2023.
Okay, well, let's pick up on that point in that case, because I think it's important now to look ahead from where we are. So let's look and ask you the question about where we go from here, because assuming this is a bear market rallies, as we know, and as you've explained, don't last forever, and we go back into that structural decline. So let me ask you to detail more about the roadmap and how you see things developing from where we are and where we could well end up at the next part of this cycle.
Well, I think for most traders and investors out there, looking at the long-term 200-day moving average as a mean reversion minimum target is likely best. And we've already seen it in the summer months that have passed, specifically on the S&P 500, but also other proxies too. I know we're already there on the Dow, as you mentioned, one of the strongest bounce backs since the 1970s. So look at the 200-day trend average as a minimum mean reversion target. But remember our roadmap model, which maps out typical fractal patterns that the market follows, the fall, rally, and then rest of fall. So we're still within that bounce back rally from oversold conditions again. And that's what tends to happen in the bear market. So you get lots of these relief rallies from oversold conditions, which can be tactical buying opportunities, but often they roll over. And hence people say that you can buy on the dip, but make sure that you manage your risk and look to sell on the rip on the way down. And figure 3, bottom right-hand side of the mosaic chart, highlights this ongoing Minsky risk pattern that I've been speaking with you about, Jeremy, for some time, which remains in play. That is not inevitable. I mean, there is a point in the sand where it could be reassessed, but for now, the trend is still down, certainly. That multi-year pattern is still in play, and it suggests a move ultimately to the pre-pandemic peak levels around 3,400, and then below that, further downside risks into the second half of next year. Of course, we need to watch that stage by stage to see how to play that in the best way.
Okay, let me, in that case, let me just quickly take us back, if we can, to go full circle. And I wanted to bring up the chart we had of the S&P 500 and look at this in the context of the lows that we had back, the COVID lows we had at 2184. So the suggestion is, Ron, we get this move up here, and as we've explained, we are still somewhere away from the red line here, the wavy red line, which is a 200-day moving average. We already explained the Dow has already reached there, but we've potentially got more upside to go on this wider market here. So the longer term pattern, just to quickly use this chart here, are you suggesting that we would possibly end up testing this COVID low that we had on the left-hand side of the chart? Or are you happy about looking at somewhere between where we are now and that point as the baseline next year to complete the cycle?
Ultimately, it will likely be a big bear fall crash of anything between 30 to 50%. That's what the historical analogs of market.
And that is, sorry to interrupt you, but that is from the record highs. That 30 to 40, the percentage move you made, you talked about, was from the record high.
Yes, and I'm looking to the bigger magnitude side, more of a 50% move in price terms, and most importantly in time terms, because of course markets move in price and time. It is an average of 2 to 3 years for an average bear, or a big bear in this case, more than likely, to unwind. So hence, there is still more room to the downside, both in terms of the price magnitude and actual time cycle itself. There are opportunities within that, of course, but it's just more of a tactical environment. Risk management becomes key, and just relative selectivity becomes more important in terms of the general outperformers that we look for. And then all of this is part of a late cycle. Once it unwinds, then the new reset can then have time to breathe and set us up for that new cycle up.
Interesting. Okay, Ron, thank you so much indeed for joining us, explaining the roadmap around this bear market rally and the mechanics behind it all. It's a pleasure being able to catch up with you. Thanks indeed for your time. That's Ron William from RW Advisory. If you want to catch up more with Ron, you can do through LinkedIn. This video will be on LinkedIn very shortly, and also you can contact Ron through his website, RW Advisory.